Monster is a fantastic company. I drink 2 of their drinks a day, but do I love a company, and most importantly, do I think the stock is a buy at these prices? Monster has performed already extremely well and is trading at a very high valuation, so I'm very critical of the stock, but let's look into it. We can see historically revenue has grown at around 10 to 13%. During 2021 to 2022, there has been higher revenue growth, but that is mostly just keeping up with inflation. We can see their gross profit has went up during that time, but not that much faster than usual. In fact, their gross margins since 2017 have been in a decline. Profit margin and free cash flow margin, though, have performed way better. Since 2013, it has gone to around 26%. There has been a dip lately, which has been due to multiple factors, but also one of them was higher inventories than before. But if we go on the quarterly view, we can already see they're back to 26% in margin, so long term, I expect that to go to where it was before. Free cash flow has already recovered and is still performing well. Monster is not only Monster anymore, they have bought a few other brands, but they're basically all in the energy drink sector. And this is what I like about Monster. It is a pure energy play. I have watched a video from Joseph Carlson. He's a fantastic YouTuber, you should go check him out. And he talked about the caffeine bubble. How every company is going into caffeine. All these fast food companies bringing out coffees, caffeinated beverages. But when it comes to energy, I think there are only 2 players, Monster and Red Bull. And people usually prefer one over the others. I prefer Monster, I do not like Red Bull. But usually these people are extremely loyal to this brand. When it comes to coffee and espresso, maybe you have your one preferred brand. But you don't mind if you go take another one. Usually people, they go to McDonald's have a coffee. They go to Starbucks have a coffee. When it comes to energy drinks, there's very high brand loyalty. And here Monster has its own core product, buys a few other brands. Those are not big acquisitions. They're usually a few hundred millions. So this growth is mostly organic, coming from Monster itself. It doesn't have to buy other companies like Coca-Cola or Pepsi does. We can see this from their net cash position. They didn't have to take on a lot of debt. In fact, they have increased their net cash position to around 3 billion now. But they are still returning money to shareholders. They have bought back a lot of stock. Since 2020 it has kind of slowed down, but they just authorized another 500 million buyback program. So the company is able to return cash to shareholders. At the same time, Monster itself is very capital light. If we can see, the operating cash flow just keeps on growing and growing, and capital expenditures are relatively flat to that. Now comes the issue though, they're currently trading at a 42 free cash flow ratio, and historically they have always been very high when it comes to that. And I understand a high valuation for a great company, but free cash flow is only gonna grow at around 12 to 10% probably. Now you say, but hold on, since 2013 they have 4x or 5x their free cash flow. Well yes, but from 2013 to 2017, they had their big margin expansion. Ever since then, margins have stayed stable or went down. I don't think they're gonna go that much above 30% margin. So I think from 2017 on, it is gonna be 10 to 12% revenue growth, maybe 1 to 2% in buybacks, and that is gonna be it. You also have to think they can't buy back that many shares at these prices. On a free cash flow yield of 2.33%, if they would put all of their free cash flow into buying back shares, they would only be able to buy back 2% of a company. That is just simply not gonna work. For the next 5 years, I'm gonna say growth rates of 10% plus 1 to 2% in buybacks, 12%. Slight slowdown in revenue growth, eventually they will have the entire energy market and it will go down and the revenue growth will flatten. But 10% is still reasonable in my opinion. They do not pay out a dividend, discount rate of 10%, terminal multiple of 18, I would come to a valuation of $26 a share. Now the current value is 57, so we see that doesn't work out. But that is only because of the multiple. If we say Monster is gonna keep trading at the valuation it has always had, around 35 free cash flow, well then it would maybe be already a buy. But I do not want to invest in this company when it relies so much at trading at a very high multiple. Now what if it goes better, 15% growth, 12% after that, 20 multiple, $36 a share. And what if revenue growth slows down a bit earlier? I'm not talking about a heavy crash in revenue growth that the company gets disrupted, but maybe just like they have cornered a lot of the energy market, not a lot of people are gonna buy more. 10% growth, 8% afterwards, 15 multiple, still fairly okay. That is a normal multiple, 19 valuation. So overall, I'm looking at Monster. I really like the product. I drink it a lot. I think the company has a great future, but I think the stock is just too highly priced right now. If the valuation comes down, which I don't think will ever happen, this is maybe gonna be another Costco, where the valuation will never come down, so you will never be able to get it at a fair price. That is completely fine with me. I have other investments I can do. What do you think? Write it down below. Have a good day.